This has never happened before. What's going on right now in the car market is literally the first time, and I'm going to explain it to you and why it's actually happening. We are seeing record level delinquencies. I'm not talking about 2008, I'm talking about right now, and I'm going to show you the data which proves that. You came here for the truth, so let me unveil that for you. You have to understand, when we start seeing delinquencies rise, that means people can't pay their bills, and we start digging one layer deeper after another and find conclusively what's going on and knowing that this was inevitable. Let me break it down for you. So you've got the issue with the cars, of course, and this is something like we had imagined would occur because when people can't pay their bills because of high interest rates, because of inflation, because of the debt, yes, you're going to encounter a problem. Did we know it was going to happen in the auto market before another one? No, not necessarily, but here we are today. Car owners fall behind on payments at the highest rate on record. The risk of vehicle repossession is rising for many Americans facing a budget crunch. Now, I want to make this very clear. They say highest on record, and that data goes back to 1994. Okay, so just make that sure, like it could have been worse at some point, but the data only goes back to 1994. And you will see that for yourself right here. You're looking at interest rate hikes making newer loans more expensive. Millions of car owners struggling to afford their payments. It's a clear indication of distress at a time when the economy is sending mixed signals. Yeah, of course, consumers don't have the spending money that they did before. But higher borrowing costs. The subprime borrower specifically is getting squeezed. And why is that important? Because that's the bellwether. First, the subprime mortgage. Here we go, a Freudian slip. Looking at the subprime borrower, we saw that in 2006, 2007. That started coming up in the real estate market. But now we're seeing the same thing with cars today. Americans struggle to afford their car payments. You could see the percentage of borrowers at least 60 days late on their car loans at a record high. Okay, now that's key. But I was shocked to see the percentages. If you look at this data, the actual percentage in which people are borrowing to get a car, to me, this seemed, how could it even be possible? But let me show you. It is, I couldn't believe it. Anyway, here we go. So I'll talk about the actual amount of money that people pay in a given month. But let's just look at the interest rates for the moment here. Look, for those with the best credit scores, interest rates are about 5% for a new car, 7% for a used vehicle. That's the average right now in the United States. For those with the worst credit, rates are about 14% and 21% for new and used cars, respectively. All right. So just thinking about that, if you had a credit score, as they say here, 580, so not a very good credit score, she's paying an interest rate of 13.5% on her 2019 Honda Ridgeline truck. That comes out to roughly $700 a month for the loan and the insurance, not to factor in the gas on top of that and so on. So a vehicle is extremely expensive. And this is, of course, you feel the brunt, particularly when you have that bad credit. And that's why fixing your credit is essential. If you want to be able to have a car, if you want to be able to have a home, if you want things, sometimes you need credit. You need access to credit. And remember, there are circumstances in which, you're okay now, but in 3 years from now, what's that going to be? Are you going to need to borrow more money because of, your circumstances? Just remember that. You always want to keep your credit in check. So you've got people borrowing anywhere between 5%, 7%, 15%, who knows? But it shows us that we could be, needing to get around our vehicle, and that could be a very big expense on a monthly basis. This was not an issue 10 years ago. Just, taking into account everything, taking into account inflation, taking into account your real incomes. Now things have been blown out of the water. Do you agree with me on that? I think it's pretty clear. That's why I'm trying to look out for you to explain these things of how did we get here? And we'll explain that further, of course. But I want to put you front and center because I have seen this over and over again where, yeah, we can get the numbers, but what does it mean to you? Let's look further. America is in a cardboard box recession. Demand for services is cooling and inflation could surge again. This is according to Charles Schwab, top global strategist. And basically the cardboard box indication is, okay, if the cardboard boxes are not in demand and then the stuff to put in that, well, this is kind of like the very first thing. We need more boxes before we can put stuff in, and that tells us what's happening in the economy. The consumer is feeling it right now. And yeah, they're feeling it because of the student loans, the mortgage payments, the rent, and of course, their car payments. All of this makes sense when we start to connect the dots. I know you're feeling it. I know people that are making six figures a year, and because suddenly everything was fine a couple of years ago, 3 years ago, and now they're in big trouble. Six figures a year. So it's troublesome. And by the way, it depends on, of course, what city you're living in. It's a cash buyer's market. Average interest rate on new car loans is nearly 10% APR. It all depends, the car company you're looking at, where you are exactly. I mean, there's many factors. But anyway, this is coming from a reputable source here. If you want to know anything about the car market, you can look at this guy on Twitter, X, and see it for yourself. Car dealership guy. But that's where it's at. And so people are paying cash right now because they don't want to pay 10%. And it makes sense if you have the cash. Record number of car buyers are paying $1,000 plus per month amid low vehicle inventory. This was back in July. But I just want to show you that people will pay $1,000 a month, and not for, anything spectacular. These are not Lamborghinis over here. We're talking about cars. Yes, they're not the bottom of the barrel type vehicle, but that's a big payment a month. What is that going to do? Of course, it's going to impact people's ability to buy other stuff. The economy cannot sustain this. Working from home for good, sell that second car. Remote workers are saving thousands of dollars a year by selling their second household vehicle. This was back in 2020. And of course, for many people, they did this. They said, we've got two vehicles here and both of us are working from home. We don't need both. So let's get rid of one. And so that was an opportunity for some to do so. But when one vehicle payment is now adding up to what it, used to be two, you have a big problem. This is crazy what has happened over the last few years. Why has this happened? Devaluation of the currency. I think it's pretty clear. When you break it down like that, it makes a lot of sense. Now, Marvin Gaye asked the question, what's going on? And we can break that down a little bit further. Disinflation doesn't equal falling prices. I know I've seen your comments before. I believe I've highlighted that in the comment of the day even. But here we go. Consumer Price Index, looking at it, comparing that, just showing us that, okay, you can see what has happened. And the CPI in a year-over-year change might go down. But that does not mean that prices go down. And they're showing us the index. That's the blue line. Of course, over time, stuff gets more expensive. And then people blame, whoever they want to. They blame a politician. They blame, a corporation, whatever. But people don't like to blame the central banks. Number one, they don't know what a central bank is. But generally, it's shrouded in mystery. And so when we start to understand that every time they print that currency, it devalues your savings. And so you struggle to pay your car bills when it wasn't a challenge before. And that's a matter of fact. Yes, there's supply and demand. There's all these different things. But knowing that, we have to start to see it for what it is and pay close attention. You could see the student loan borrowers. I couldn't believe this. They racked up credit card debt during the payment pause. This is a big problem. So we don't have to pay the $400 a month for the student loans. So we're going to take on credit card debt at this time at 20% interest rates. My goodness, 18%. Who knows what they were borrowing at the time? That is a double whammy. And so this starts to add up and paint a whole picture. The consumer is suffering. People are in more debt than ever before, and interest rates tied to that debt is at levels we haven't seen in decades and decades. And so this creates a potential for a deleveraging event. Deleveraging. And what does this mean? It means essentially people have to start letting go of these things, these big ticket items that they've bought with debt. Or in some cases, people are buying everything with debt. And now the potential cause, of course, would be inventories of everything rising and companies freaking out and panicking. Layoffs would ensue, and you would have a deflationary environment. Rapidly, the result of this would be, okay, the car companies are in trouble. All right, let's begin the bailouts. Everybody get out there and start throwing cash at these companies. You would also have, potentially, who knows, another round of quantitative easing, interest rate cuts, and more inflationary policies coming from the central bank. And that, my friends, is what this is all about. I hope I made myself clear. There's a lot of data to support this. You could see it. Rising interest rates lead to valuation reversals every single time. Do you see what I'm trying to get at here? People say, it's all these charts and article. What does this even mean? There's a method to the madness, but you've got to watch through the whole thing because I have a reason. I put these all in order for a reason. You could see that. Look, I want to give you what you need to know, and I think it's pretty simple. When we start to understand what the central banks are doing, then of course that starts to break it down and realize, wait a minute, if they're going to be printing money, that means risk assets will be worth more as a result, nominally. And that's why we saw during this run-up in 2020, the things that were considered the riskiest, and I talk about this all the time to my live class on the Fridays, I say, look at Zoom versus ExxonMobil in 2020. ExxonMobil was worth less than Zoom. I'm talking about the video conferencing software being worth more than ExxonMobil, one of the biggest companies in the world, and in 2013 was the biggest company in the world. You know, things get topsy-turvy, but every single time that's the way it is. And they stop that by increasing interest rates. This is what they do. You look back, I have studied all the history, so boring, falling asleep reading it. That's how boring this stuff can get sometimes. When you're reading through books like America's Great Depression by Murray and Rothbard, and he's telling you the name of every single person that is at a meeting, and you're reading that over and over and over again, trust me, you fall asleep. But in the end, when you finish the book, you are more informed. Now, I've done that for you. I've already made it easy. And look, 95% of the information I've read, it probably has gone out the window. But the 5%, the important stuff, I bring that to you. And I've condensed some of that, the absolute basics, in what I call Compass. And the best part about Compass is that you're not going to pay $999, you're not going to pay $500, you're not going to pay $100. In fact, you're not going to pay anything. It's free. I made it for you for free. All you got to do, there's no email address, there's no paywall, there's nothing. All you got to do is go to the link in the description, check out Compass, tell your friends and family. I didn't even put a link anywhere on that page to my YouTube at all. So you send that link to somebody and they will have the basics of financial education, whether that's you, whether that's a family member. And it's like 20 minutes of video. It's super short and they're going to get the knowledge that they need. I hope you'll do that. and I hope you'll give me some feedback on it. I want to know what you think. I'm always ears, so please let me know. If you are the type of person that wants to be in a small Zoom class, hands-on, you want to actually understand things. We've got a Friday class that's all about economics. That's all about the stock market. We break it down. This is what has happened this week. This is what you need to watch out for. These are the potential investments. That's the Friday class. On the Sunday class, it's all about e-commerce. It's all about business. Okay, it's a small class, Zoom class, anywhere between like 2 and 6 people at any given time, depending who could show up that day. And you can get more information about that at themoneygps.com or at the link in the description where it says mentorship. Okay, I want to see you there. Okay, check that out. And comment of the day. Thank you very much, Ron, for your comment. I always thought of reclusive hermits to be odd, and now I've realized how they are right. We call them preppers now. Isn't it so funny the way things change, the way things happen? Certainly, we are in some wild times. I want to thank you all for being here today. And don't forget to check me out tomorrow. Make sure your notifications are there. Even if they are, they might not notify you. But I hope that you'll check me out tomorrow. See you then. Take care.